Bitcoin goes way up, they're going to sell a little bit to get that. If Bitcoin goes way up in in relation to their overall portfolio, they're going to rebalance it to get it to the right percentage. And if it goes down, they're going to buy more and rebalance to get to the right percentage. And so they're just going to continuously rebalance, and that will help dampen the volatility over time. And that's where it gets to that true store of value, and which is where we're headed, in my opinion. And when we get there, and we continue with this debt spiral, we continue with the deflation, the devalue of the dollar, that confidence of holding dollars continues to go down, holding treasuries and knowing that, oh man, I don't want to have a 30-year treasury. I want to hold something that will really give me store my value, that hold against inflation. Then you'll start seeing investment firms and investors allocate out of long-term bond portfolios and into Bitcoin, and that's a ways off. But when they do that, then the whole game has changed, and that's where Michael Saylor's, all your models are broken comes into play, and Bitcoin becomes the ultimate store of value for investors.
James Lavish begins by discussing Bitcoin's place in the adoption phase, where massive price volatility is still present. This volatility, according to Lavish, stems from the inflow and outflow of capital into the protocol, which significantly impacts Bitcoin's price movements. Although volatility can be unsettling for investors, it is important to note that Bitcoin's price generally trends upward over time. This positive volatility is what drives Bitcoin's long-term value growth, a fact that should be comforting to investors looking for long-term gains. According to Lavish, Bitcoin's volatility needs to diminish before it can mature into a widely trusted store of value, similar to gold. For this to happen, Bitcoin's market capitalization needs to grow significantly. Gold's market capitalization stands around $10 to $12 trillion, and for Bitcoin to reach the same level, it would need to capture 2% of the total global asset pool, which translates to a value of around $18 trillion. Once Bitcoin attains this level of market capitalization, it will likely trade between $250,000 to $350,000 per coin. At that point, large institutional investors could begin moving into Bitcoin without affecting its price dramatically, enabling smoother transactions and less volatility. This would pave the way for Bitcoin to function as a proper store of value, much like gold does today.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We're in the adoption phase. You have massive volatility still in the protocol. As money tries to come in and out of this protocol, it moves the price greatly. We use the US dollar here. You can look at, the Bitcoin against other currencies, and it's even more volatile. But the volatility is to the upside, which is good. So as it's doing this, it's going up over time. So what do we need? We need more money in the protocol. And I like to look at, total assets in the world, total investable assets in the world. When you add it all up between the $140 trillion of bonds, $140 trillion of stocks, and then you've got your hundreds of trillions of dollars of real estate, your art and collectibles, your M2, just your cash, gold. You add all that up, the investable assets in the world, and you get about $900 trillion. Okay, so if you say Bitcoin's around $1 trillion right now, when Bitcoin becomes it matures into a separate asset class like gold. Okay, so gold is always listed in that asset asset rack because it's an investable asset, and people use it as a store of value and a flight to safety. When you see wars going on, you see instability in markets, money floods into gold, which you saw gold rise yesterday. I think that's two reasons, because people are thinking, oh boy, they just lowered rates 50 basis points when inflation's still above their target. we're going to get more inflation, and I want to hold something that's going to keep up with inflation, and gold does that. You know that gold is a good store of value because you could always buy a good suit with an ounce of gold, and a well-made suit with an ounce of gold, and you can go back in time and see that over the time, and it still holds true. Okay, so we use that one. So, but whereas Bitcoin is it? Well, Bitcoin went up yesterday because, well, a surge in risk assets. It still acts like a risk asset where when people want to go out on the risk curve, they'll buy Bitcoin because they don't fully understand it yet. And they're not going to be able to use it as a store of value until that volatility comes down, until we get closer to that, the amount of money that is in gold, the market value of gold, right? So Bitcoin has to go up, closer to 2% of the total investable market, the $18 trillion, to get to the value of gold, to be that kind of store of value and be that trustworthy store of value for investors, which it will get to. It's taking time for people to understand it fully. But when we get to about 1% of total investable assets, I think we're about there, because when Bitcoin is trading somewhere between $250,000 to $350,000 per coin, that's going to make it much easier for investors to get in and out of. Number one, without friction of moving the market by trying to get in and out of large amounts, large quantities of it. That's one thing. The second thing is, with institutions coming into the market with the ETFs, it's really important to understand that there's a few things going on with institutions. Once they really do truly understand Bitcoin and they do their work and they understand why it's different, they're going to want to allocate to it as a separate asset. And when they do that, they're going to allocate 1, 2, 3% of a portfolio to it, maybe as much as 5% in some portfolios. And so they're just going to buy what they need in the market and just go along with the market. They're not going to be as price sensitive as you and I would be.
Yeah.
However, they get to that percentage of their portfolio, and then they rebalance. So if Bitcoin goes way up, they're going to sell a little bit to get that. If Bitcoin goes way up in relation to their overall portfolio, they're going to rebalance it to get it to the right percentage. And if it goes down, they're going to buy more and rebalance to get to the right percentage. And so they're just going to continuously rebalance, and that will help dampen the volatility over time. And that's where it gets to that true store of value, and which is where we're headed, in my opinion. And when it gets there, and we continue with this debt spiral, we continue with the deflation, the devalue of the dollar, that confidence of holding dollars continues to go down, holding treasuries and knowing that, oh man, I don't want to have a 30-year treasury. I want to hold something that will really give me store my value, that hold against inflation. Then you'll start seeing investment firms and investors allocate out of long-term bond portfolios and into Bitcoin, and that's a ways off. But when they do that, then the whole game has changed, and that's where Michael Saylor's all your models are broken comes into play, and Bitcoin becomes the ultimate store of value for investors.
Lavish argues that the Fed and the Treasury have a vested interest in preventing a deflationary event, which would destabilize the Treasury market. If unemployment spikes, GDP declines, and businesses start laying off workers, there would be less capital available to buy U.S. Treasuries. This is particularly concerning in light of the U.S. government's massive budget deficits, which exceed $2 trillion annually. Lavish warns that these economic pressures could drive more investors to allocate capital into Bitcoin as they seek assets that can withstand inflationary forces and serve as a reliable store of value.
The inflation has been stuck well above 2%, 2.5% to 3% for a number of months now, going into earlier this year. And so you wonder, well, why is the Fed ready to lower rates all of a sudden if inflation is still above their 2% target? It's a good question. The second question is, well, we did see unemployment rise. It rose above. If you look at, there's one indicator that the Fed really likes to look at. It's called the Somm rule, and the Somm rule was created by Claudia Somm. She was a Fed employee, and she economist, and she came up with this rule after her time there, I believe, or at the end of her time there, and the rule says that if you take the average unemployment rate for the last 3 months and compare it to the lowest point of this cycle of the last year, then if it's more than 50 basis points, more than 0.5% above that lowest rate. So, to put numbers on it, if the lowest unemployment rate was 3.5% and the average the last 3 months jumps over 4%, technically we're in a recession. That means that the unemployment rate is rising fast enough that you are concerned that we're about to have a spike in unemployment. If you look back in time, you can look at charts of unemployment versus recessions, and every single recession, unemployment just spikes right into it. And so, and it happens right after it crests that 0.5%. Okay. So now you're thinking, well, maybe, oh God, this means we're going to go into recession. We tripped the Somm rule, 2 readings ago, and it looks like we're going to be spiking right into recession. We better lower rates. Is it panic time? And the answer is no. There's a lot going on here. So typically and we heard what Powell said 2 meetings ago. So to lead up to this meeting, you have to think about 2 meetings ago. And he said that the dual mandate has come back better into balance, meaning that they're doing well with the inflation battle. They've gotten inflation down below 3%. It's going towards 2% in his words. I think it's kind of stuck at 2.5%, but we'll talk about that in a second. But the second one is he saw rising unemployment and he's concerned about that. So now they turn their attention to unemployment. So they've had their attention fully focused on inflation. Now they're like, well, now what about unemployment? Let's focus on that. And so going into this meeting, you knew that was kind of on their mind. Trip the Somm rule, and the second unemployment reading was kind of it was a little bit noisy, but it didn't jump, so that was good news. But then going into this meeting and looking at the press release, you can read through the lines and hear what he said in the press conference afterwards. The press conference afterwards, Powell said, "Look, the unemployment rate, it's stable, but the reason we believe that the influx of many millions of immigrants have they've affected that rate. And so when you have 5, 10, 15, 20 million immigrants, who knows how many there really are, somewhere between 10 and 20 million immigrants come into this country, then unemployment will go up.
Because the labor supply goes up.
Yeah, exactly. So, but it's an increase in labor supply rather than a decrease in available jobs. And that's a big deal. Okay, so now you've got this big mess. We've got unemployment is kind of rising, but some of it is due to the influx of participants, like you said, but inflation is kind of stuck at 2.5%. Why? So, and why would they be lowering rates now? The simple answer is because the last thing that the Fed and the Treasury want is to destabilize the Treasury market by having a deflationary event. Meaning, if we have a spike in unemployment, we have mass layoffs, the stock market sells off, companies are making less money, they're laying people off, their GDP goes down, and there's just not as much money to buy US Treasuries. That's a problem. Why is that a problem? Well, the problem is because we're running massive deficits. We're running $2 trillion plus deficits, $2 trillion plus deficits annually in a time that we're not even in a recession. So that is an issue.
Lavish's view, as investors lose confidence in long-term government bonds, they will increasingly turn to Bitcoin. The current bond market is unsustainable in the long run, particularly as inflation erodes purchasing power and governments continue running massive deficits. Lavish sees a future where Bitcoin becomes a preferred alternative to bonds for investors seeking protection from inflation and currency devaluation.
Please like and subscribe my channel.